Treasury. Now we will see what do you mean by Treasury risk management. So before that, so why Treasury is risky? So Treasury is a risky one. That why it is risky we will see. So usually what they will do, they will take the money of the bank. The Treasury office, what they will do? Treasury office, it is nothing but it is a bank's office. So what they will do, they will invest in the market. So while we know that these share markets, while investing shares and bonds, there is a risk. That the risk may be interest rate risk, the risk may be liquidity risk, the risk may be market risk, right? So these are the risks involving while we are investing in the shares and bonds. So basically this treasury means investing the money in the share market, and from that they will get the profit. Not only share market, but in the government security bonds they will invest. Even in government security bonds also, there may be sometimes there is a yield change. So due to that, there is a change in the interest rate. So that there may be a fluctuation in the income. So these are all the risks involved in the treasury. So treasury always, remember, it handle in terms of millions. So if it is a 1% also, it costs some lakhs and crores. That's why the first point is leverage. Leverage means high leverage means the amount the treasury is dealing is more. So here he told value of transaction is very high, say 100 crores, and 1% adverse movement also may result into loss of 1 crore. So treasury means usually they will deal with more amounts. Let us suppose 100 crores. What is 1% of 100 crores? If there is a change in the interest rate or there is some change due to some other factors, there is a change in 1% interest. Then there will be loss of 1 crore. 1% of 100 crore is 1 crore. So 1% little change also it will cost more. So that's why treasury is risky. And next one, banks don't involve in the treasury. So treasury department is responsible for buying and selling. So that is bid and ask. So bid means buying, ask means selling. So bid price, ask price, the treasury department officials should decide. So that's why there is a sole discretion of treasury department to sell, buy or keep open position. So it is depend upon they gave the full rights to the treasury department of that bank. So next one, transactions are confirmed and irrevocable. So once we enter some amount, that we can't reverse. Sometimes we know that in share market, so it is like we should be very conscious. So once the transaction is happened, then we can't reverse that transaction. So if there is any typing error, like let us suppose it's 100 crore. So let us suppose we type something one more zero extra, or we are there's a typing mistakes means it costs more. So there is a responsibility of treasury department to see these things. Treasury department. Now the types of risks we told, okay, treasury is having risks. So what are those risks? We will see. So that risks involved in the treasury. So first one is market risk. So we will see what do you mean by market risk. This all we know that market risk means it involves liquidity risk, exchange rate risk, interest rate risk, and equity and commodity risk. This we will know that in the first chapter itself we discussed. Market risk means it involves these risks. But coming to Treasury, how we have to define these terms? So risk means same. Market risk means the definition is same. But while coming to Treasury, how that market risk will happen to Treasury, that we have to see. So we'll see one example here. So let us suppose we borrow from money market and invest in securities, government securities. If bond prices are come down, we can't sell the bond. So there is we invested in a 5-year government security bond. Let us suppose market price is let us suppose we only invested in the share market. If the prices are less and it is coming down, let us suppose in COVID time the share market prices are very less. That time no one sold those shares. Why? No one sells it for loss. So now also the trend of the share market is anyways it is going down. So now people are not selling their shares. So in the similar fashion, Treasury departments also don't sell bank shares when it is in loss. The share prices are coming down. That time the Treasury department of bank don't sell these shares. So that time what will happen? So our money is stuck with the share market. Then what kind of risk arises? Liquidity risk. So what is the definition of liquidity risk? If there is a shortage of funds will result in liquidity risk. So liquidity risk definition is same. Shortage of funds means that kind of risk is called as liquidity risk. So in Treasury, how that liquidity risk will happen? So when the share prices are less or bond prices are coming down, then what will happen? Treasury department can't sell those shares. So what will happen? The money will get stuck with the shares. So we have a shortfall of money. So shortfall of money will lead to which risk? It is liquidity risk. So remember, in the first chapter also we have these definitions, types of risk we discussed already in the other videos. So simply risks definition is same, but in Treasury how it will happen we have to remember. So while investing in the shares, there is a shortage of funds. This will lead to liquidity risk. So next risk we'll see. Interest rate risk. Now we know that what is interest rate risk? If there is a mismatch between assets and liabilities. So we gave some loan, but that person not repaid. But bank having FDs and all those things, savings accounts. For that CASA accounts, bank should pay the interest. For the savings accounts and FD accounts, bank should pay the interest. And if the loan person is not repaying the interest, how bank will adjust these money? So there is a mismatch. So that kind of risk is called as interest rate risk. Now we will see how it will happen in the Treasury. So in the Treasury, interest rate risk will happen when there is a so how it will happen? So we don't have a money. So further, if we want funds, so let us suppose we want funds. That time, if they are asking us very higher rate, then that higher rate leads to the interest rate risk. So very simple. So if we want funds, so Treasury Department wants some funds. They want to arrange some funds. So that time, if the person who is giving that funds, if they are asking higher rate, then that kind of risk is called as interest rate risk. So first one is liquidity risk we discussed. So liquidity risk is done, and interest rate risk is done. Now we'll see currency risk. So what is currency risk? So currency risk means it is depend upon other countries. So maybe some domestic or international factors that will lead to currency risk. So I already told that it is like share market bonds, na? So there is a inter states, inter countries also it will happen. So that's why there is a risk called currency risk due to exchange rates. So America, it depends upon USA dollars and Malaysian their currency. So it is depend upon different countries' currencies, this exchange rate. So it depends upon that international factors also. So next one, equity risk. So equity risk means, so there's a definition called fluctuation in the market price of shares and bonds, that is called as equity risk. So equity means we know that shares and bonds. Shares and bonds. Next, what do you mean by commodity? Commodity means it is gold, silver, and etc. are called as commodities. The risk of those commodities will lead to commodity risk. So what are those? If there is a change in the market price of these commodities, that is also risk. So whenever there is a change in market price of shares and bonds, means it is equity risk. Gold and this thing means change in commodities, means it is commodity risk. So these are the risks involved. Now, and the last one is credit risk. This we all know that. So whenever the person who has to repay the money or who has to give us the money back, if he is not giving, then it is credit risk. So in Treasury also same thing will happen. How it will happen? If we buy from some other person, but he is unable to give that, then that kind of risk is called as seller risk. And counterparty risk, the person who is who has to give us money, that if he is not giving, that is counterparty risk. Sovereign risk, that is country risk. So these are the risks involved in the credit risk. So the risks, these are the risks involved in the Treasury Department. Now we know that every organization has its own policy to control those risks. How bank is controlling these things, we'll see. So how bank is controlling, we'll see first. So types of control. So every banks in they're having some their own controls. So the first one is organization controls. So in especially in Treasury, there is a 3 terms called as front office, mid office, back office. So each office has its own duties. So managing these money and bond prices and one department. So watching these bond prices and market prices is other department. So the several duties segregated to front office, back office, and mid office for effective monitoring and control. Next one, internal control, means they have some limits. They have limits for deal size limit. That means 100 shares we have to purchase, or 100,000 shares we have to sell. Like the deal size limit they fix, and open position limit, that the price when we open position, and stop loss limit, and daylight limit, and overnight limit. So these limits our bank will set for those treasury offices. Next one, exposure ceiling limit. Exposure, this name we know. Exposure means the loan without having collateral. So exposure limit means here it is fixed on the basis of credit rating. This exposure limit will be fixed based on the credit rating. If the credit rating is nice or good, then we can take the risk. So these deals takes place at DVP. So in exam, he may ask what is the full form of DVP? Delivery versus payment. Delivery versus payment. DVP means delivery versus payment. So RBI has imposed ceiling of 5% of total business in a year for the individual broker. Remember, this is also RBI has imposed a ceiling of how much? If the bank business is some 500 millions, then they can do only 5% of that business for the individual broker as a treasury management. And next one, measurement of risk. So we know that treasury, we are discussing now the topic treasury risk management. So how we have to measure the risk? So we have two important methods. So first one is this one, second one is this one. So we'll see the definition of those things, and we will discuss the example. So first one is where, that is value at risk. So why we need where means, so it is basically involves in volatility. So in the June examination, he asked in the BFM CAIIB examination, volatility. So the other name for volatility is standard deviation. That is square root of variance. So he gave some data. So we have a formulas for mean. Mean means average. In similar fashion, we have a formula for variance. That is x square minus x bar whole square, that is mean whole square, that we will see in the examples. So he asked what is volatility for the given data. So there the data means that for data how we have to calculate volatility means simply we have to calculate the square root of variance, that is standard deviation. So standard deviation is nothing but volatility. So basically it is useful to indicate the worst movement of market rate over the given period under normal market conditions. So we'll see how this where will useful, that is value at risk will useful for the calculating the risk. So the given example is first one. So there is a risk. There is a value at risk of 45 BPS for 95 confidence interval. If the spot price is 46 rupees, then what is the risk? How much amount? What are the chances that the amount will decrease? Means, let us see, we'll see here. So there is a risk of 45 BPS. So what is the risk? 46 minus that amount. We know that BPS means we have to divide with 100. So 46 minus 45 by 100. BPS means we have to divide with 100. So 46 minus that amount will give the answer. So he told the value at risk amount is 45 BPS and the spot rate is 46. Then he is asking what are the chances that the rate will decrease further? So there is a chance that it will decrease 46 minus 45 by 100. That means 46 minus 0.45. That means it is 45.55. So when there is a value at risk of 45 BPS, the rate may less than 45.55. Simply we have to subtract from that given BPS value. Now one more example. Now one more example we'll see. If overnight varies 0.35% for the government securities and the yield is 7.75, then what is the change for tomorrow's price? So he told the risk amount is, that is value at risk, is this much and the yield is this much. Simply we have to subtract 7.75 minus 0.35 will give 7.7 minus 3, 4. So the value may be 7.4. 7.4. Now we'll see important points of this where. So last time they asked in the exam. So what do you mean by where? Where means nothing but it is volatility. And next means, what is volatility? It is nothing but SD. SD means standard deviation. So last time it is asked you. So what is where means it is volatility. So how we have to calculate this where or volatility means using mean observations. From the mean observations, we have to calculate the standard deviation. The standard deviation means volatility. This volatility means value at risk. Now, this is suggested for only shorter period.